So we've learned about forwards and futures, which are derivative securities that create an obligation on the part of the holder to conduct a transaction at some later time. In this lesson, we'll introduce derivatives that give the holder an option rather than an obligation for that future transaction. These types of derivatives are called options. There are two basic types of options, though each has plenty of variations. The first type is known as a call option. A call option gives the purchaser of the option the right to buy an asset at some point in the future at a price that is set today. Notice that it is a right to buy the asset, not an obligation to buy the asset. We'll discuss the conditions under which the purchaser would choose to exercise that right. The benefit to the purchaser of a call option is that they receive the upside potential of the asset appreciating in value, as compared to the purchase price defined by the option, while eliminating the downside of the asset falling in value. For example, if you're holding an option that gives you the right to buy a share of stock for $100 and the stock price declines over time to $80, you would simply not exercise your option because you would be paying $100 for an asset with a market value of $80. Now consider the seller of the call option. Throughout this course, I want you to always think about both parties in a transaction and how the transaction impacts both of them. If you've sold a call option, you have obligated yourself to sell the underlying asset if the purchaser chooses to exercise that option. Think about that call option that allows the purchaser to buy a share of stock for $100. What happens if the share price increases to $500? The purchaser would almost certainly exercise the right to buy a stock worth $500 for only $100, and the seller of the option would be obligated to deliver it. So why would the seller agree to this seemingly one-sided risk? Think about that as we move forward. So here we have an example of a call option transaction. The buyer of the option obtains the right to buy the underlying stock index for $1,020 6 months from today. If after 6 months the index value is $1,100, then the buyer would exercise the option. In most cases, the option exercise is settled in cash rather than an actual delivery of the underlying asset, as was the case for forwards and futures. So upon exercise, the seller would pay the buyer the difference between the market value of the index, which is $1,100, and the predefined purchase price, which is $1,020. The buyer thus receives a payoff of $80 from the seller. If the index value was instead $900 after 6 months, then the purchase price exceeds the market price. The buyer would not exercise the option. If the buyer really wanted to own the underlying index, they could just go to the open market and purchase it for $900 rather than pay the $1,020 defined by the call option. No transaction would thus take place and no cash would change hands. So let's revisit our question about why anyone would agree to sell a call option given the seemingly one-sided risk. One answer is that the buyer pays up front for the right conferred under an option. In this example, if the index price ends up at 900, or really anything less than 1,020, the seller of the option would pocket the amount that the buyer paid for that option. We'll talk more about this going forward. So we've defined the basic structure of a simple call option. Now let's look at some terminology. The purchase price of the underlying asset that is defined by the call option is called the strike price. In the example on the prior slide, the strike price was $1,020. The strike price is typically denoted by the capital letter K, and the price of the underlying asset is denoted by capital S, with a subscript corresponding to the point in time. For the asset price at expiration of the option, we use capital S, subcapital T. To exercise the option is to take advantage of the rights provided by the option. For a call option, this would mean paying the strike price to receive the underlying asset, or in a cash settlement situation, to receive the difference between the asset price and the strike price as a cash payment. The rights conferred by an option are always for a finite period of time, and thus an option always has an expiration date. If the option is not exercised by the expiration date, it becomes worthless. Finally, we have 3 different broad styles of options that are based on the rules governing when the option can be exercised. European options can only be exercised at a single point in time, which is the expiration date of the option. So for a 6-month European call option, the decision regarding whether to exercise can only be made after the 6-month period has elapsed. American options, on the other hand, can be exercised at any time prior to expiration. You don't need to wait until the end of the period. Bermudan options fall in between European and American options in that they can only be exercised at specified points in time. For example, you might have a 1-year Bermudan option that allows you to exercise only at the end of each quarter, or maybe only at the end of each month, but not at any day in between those points. When we sell an option, we're said to be writing the option. Think of it as someone has asked you to sell them an option, and you need to write out the terms for the transaction. Remember that the buyer of an option pays for the right. The amount paid is known as the premium. For example, the buyer might pay the seller a premium of $5 for the right to purchase a stock for $100 at the end of 6 months. As you might expect, the premium is related to the expected payoff of the option. If the expected payoff is high, then the premium would be high as well. Finally, we have what's known as the moneyness of the option. This refers to whether or not the option would be profitable to exercise at a given point in time, which is a function of the strike price and the underlying asset price. If the strike price and the underlying asset price are equal, the option is considered to be at the money. Here, there is no advantage to exercising or not exercising. If exercising the option immediately would be profitable to the buyer, then the option is considered to be in the money. For example, if you're holding a call option with a strike price of 100 and the underlying asset price is 110, immediate exercise, whether it's permitted or not, would get you a $10 payment, and so you are currently in the money. Conversely, if exercising the option would not be profitable to the buyer, then the option is considered to be out of the money. The payoff of an option is the amount of cash that changes hands upon exercise of the option. For a call option, the payoff is the market price of the underlying asset at exercise minus the strike price. There's a floor of 0 because if the asset price was less than the strike price, then the buyer would simply not exercise the option. Our notation for the payoff is the maximum of 0 and S sub t minus k. The profit of an option takes the initial premium payment into account and is defined as the payoff less the time-adjusted future value of that premium. Let's look at an example. We have a 6-month call option with a strike price of 1,000 and premium of $93.81. We need to know the risk-free interest rate to time adjust the premium payments, and that's given here as 2% for the period. Note that it's not a continuous rate, just a factor of 2% for the 6-month period. If the index value increases to 1,100 after 6 months, then the option is in the money and it will be exercised by the buyer. The payoff is the difference between the spot price of 1,100 and the strike price of 1,000, or $100. The profit to the buyer is that $100 payoff minus the future value of the $93.81 premium that's paid at time 0. We multiply the $93.81 by 1.02 to represent the interest factor and subtract it from the $100 payoff, which results in a profit of $4.32. So why do we time adjust the premium payments? It's because by paying the premium, the buyer has lost the opportunity to receive 2% risk-free interest for the 6-month period. This lost interest needs to be reflected to obtain a true sense of the economic profit from the option. If the index value is instead 900 after 6 months, then the option is out of the money and will not be exercised. There is no payoff, and the buyer's profit is the payoff of 0 less the interest-adjusted premium, which results in a profit of negative $95.68. A negative profit is a loss, so the buyer has lost this $95.68. This slide introduces payoff and profit diagrams. These can be extremely helpful in understanding the behavior of options. On the left, we have a payoff diagram for a call option on a stock index that has a strike price of $1,020. The x-axis here is the underlying index price at expiration of the call, and the y-axis is the payoff. At index prices of less than 1,020, the payoff is 0, as the option simply wouldn't be exercised. As the index price increases from 1,020, the payoff increases dollar for dollar, which is shown here by a line with slope 1 to the right of the 1,020 strike price. So the payoff is 100 when the index price is 1120, 200 when the index price is 1220, and so on. On the right, we have a profit diagram for this call option. The profit line here is exactly the same shape as the payoff line from the chart on the left, except that it's shifted down by 95.68 to reflect the interest-adjusted premium. So for index prices less than 1020, the profit is the same negative 95.68 no matter how low the index price gets. Once you hit that 1,020 strike price, the profit increases at the same dollar for dollar rate as the payoff. The profit reaches 0 once the index price increases by the 95.68 interest-adjusted premium, which would be at an index price of 1115.68. Any further increase in the index price results in a positive profit. The right-hand chart also shows a line for the profit on a forward contract with a strike price of 1020. As you can see, the profit on the forward is higher than that for the call option for much of the chart. And this is because you don't have to pay a premium to enter into a forward contract. But look at the left-hand side where the index price drops below about 900. Here, the call option starts to look better and better since there is downside protection on the call option since you don't have to exercise it, but no protection for the forward. Now let's look at the payoff and profit from the perspective of the seller or writer of the call. First, the payoff to the writer of the call is simply the negative of the payoff to the buyer. It's the negative of the amount by which the stock price exceeds the strike price. Just like the payoff to the buyer is always non-negative, the payoff to the writer is always non-positive. The profit to the writer is this payoff, which again is either a negative number or zero, plus the interest-adjusted value of the premium received. So while the payoff cannot be positive from the perspective of the writer, the profit can be positive if the future value of the premium is larger than the absolute value of the payoff. The example here shows that the payoff and profit amounts for the writer are exactly the negatives of the payoff and profit amounts for the buyer. You can compare these results to those provided for the buyer 2 slides ago. Now let's look at the other basic option, the put option. A put option gives the owner the right to sell the underlying asset at a predetermined price during the time period of the option. Recall that a call option provides the right to buy the asset. A put option is just the opposite, in that it provides the right to sell the asset. As with a call option, a put option is exercised at the discretion of the holder. The seller or writer of a put option is obligated to buy the asset from the holder of the put if the option is exercised. The payoff of a purchased put, or a long position in the put, is the greater of zero or the strike price less the asset price. So here, the option will be exercised if the asset price is less than the strike price. So a put holder is hoping that the asset price declines. The profit of a purchased put, just like that for a purchased call, is the payoff minus the future interest-adjusted value of the premium paid for the put. So the profit is calculated exactly the same way as for a call. It's just the payoff component that's different. And finally, just like for a call, the payoff and profit amounts for a written put are simply the negatives of those for a purchased put. Let's look at an example of a put. Here we have a 6-month put option with strike price 1,000 and a premium of $74.20. The risk-free interest rate is the same 2% for 6 months as we had in the call example. If the index value at the end of 6 months is 1,100, then the put finishes out of the money and won't be exercised since the final asset value exceeds the strike price. The payoff for the purchaser is zero, and the profit is a loss of the interest-adjusted premium amount, or $75.68. If the index value is instead 900, then we have an in-the-money put option and it will be exercised. The payoff for the purchaser is the amount by which the strike price exceeds the index price, or $100. The profit is this 100 less the interest-adjusted premium amount, or $24.32. Again, the payoffs and profits for the writer of the put will be the negatives of these amounts. This slide provides a table and a diagram for the profit of the put in the previous example. As you can see in both the table and the diagram, if the index price exceeds the strike price, no matter how high the index price gets, the payoff on the put is zero and the profit is the same negative $75.68. As the index price drops below the strike price, the payoff and profit both increase dollar for dollar all the way until the index price drops to zero. This is represented by a line with slope -1 to the left of the strike price on the diagram. As before, we compare the profit on the put to the profit on a short forward position. This is the profit that you would receive if you sold a forward contract. For the short forward, since there's no premium to be paid, the profit is equal to the payoff, and this results in a line with a slope -1 that intersects the x-axis at the strike price. This diagram illustrates the protection provided by the put option as the index price increases toward infinity. The short forward loss keeps increasing, but the put option loss is capped at the future value of the premium. You've probably figured this out by now, but here are a few fundamental properties of the behavior of option values. First, as the underlying asset appreciates in value, a call option on that asset becomes more profitable and thus more valuable. This makes sense because if you hold the right to buy the asset at a fixed price, clearly that right becomes more valuable as the asset becomes more valuable. On the flip side, a put option becomes more profitable or more valuable as the underlying asset declines in value. The concept is the same. If you hold the right to sell an asset at a fixed price, your profit grows as the difference between that fixed price and the actual asset price grows. The power of options can be illustrated by an example. Let's say that we want exposure to a certain stock and we have $100 to spend. We're considering two potential purchases. Either we purchase one share of the stock or we purchase 40 call options with a strike price of 100 that are selling for $2.50 each. Let's look at what happens based on some very small movements in the stock price by the end of the call option period. To keep things simple, we'll ignore the time value of money here and just assume that our interest rate is zero. If the stock price increases to $105, then our strategy of buying the share of stock would provide us with a return of $5, since we paid $100 for an asset that is now worth $105. If we had purchased the call options instead, we would exercise them and would receive $5 for each of the 40 options. Thus, we would receive $200 for an initial investment of $100, so we have doubled our money with a $100 return. If the stock price increases to $101, our return from buying the share of stock is just $1. If we bought the call options instead, we would exercise the options and receive $1 for each of the 40 options, or $40. However, we paid $100 for these options, so our return is actually a loss of $60, even though the options finished in the money. If the stock price decreases to $98, our strategy of buying the stock results in a loss of just $2. But our call options would finish out of the money, meaning no payoff at all, and we have lost the entire $100 investment. This example illustrates the concept of implicit leverage. Investing in options is an extremely leveraged way to invest in the underlying asset, in that very small changes in the asset price can lead to quite volatile outcomes. This table from the book provides a nice summary of maximum possible profit and loss outcomes for forwards, calls, and puts. I won't spend time on this table, which I think is self-explanatory, but I think you should get familiar with these ideas to help you visualize the behaviors of these securities. It's always helpful to take the underlying asset price to the extreme, either 0 on one end or some very large number on the other end, and think about how these extreme prices will impact the profit of the buyer, shown here as the long position, and that of the seller, shown here as the short position. Finally, we have a quick quiz. This quiz is not intended to be difficult, but I hope that by the time of the first exam in this course, you'll be able to answer these questions very quickly. If you can avoid spending time on these very basic concepts, you'll have more time to think about the more advanced concepts, which is true for both this course and for exam IFM. So the quiz asks you to determine whether each of the following options are in the money, at the money, or out of the money if the underlying stock is trading at $55 per share. First, a call option with strike price of 50. A call option is in the money if the underlying asset price exceeds the strike price, so this call option would be in the money. Second, we have a put option with a strike price of 55. This one's the easiest. For any option, if the underlying asset price equals the strike price, it's at the money, and there's no advantage or disadvantage to exercising. Third, we have a put option with a strike price of 50. This is always the most difficult one for students to grasp because a put option becomes more valuable as the asset price declines, which can be somewhat counterintuitive. So a put option is in the money if the underlying asset is lower than the strike price. Here, the asset price is higher than the strike price, so the option is out of the money. Exercising it now would result in no payoff at all.